The last thing is net stable funding ratio. So banks should have a healthy funding ratio. Okay, available stable funding divided by required stable funding should be greater than 100%. That is net stable funding ratio. NSFR is defined as the amount of available stable funding relative to the amount required for stable funding. Stable funding means there will be healthy funding. If you pay from your depositors money, you lend certain amount from your depositors money, that will be healthy. But if you borrow from a unreliable resource to lend somebody else, so that will be unstable one. So this is defined under net stable funding ratio. The NSFR is generally calibrated such a way that it says that long term fundings are safer. Okay, so and also they say that such short term deposits provided by retail customers and funding provided by small business customers are behaviorally more stable than wholesale funding of the same maturity from other counterparts. So they says when you get short-term fundings, short-term deposits from your customers, this is that is up to less than 1 year, or small businessmen, these are stable fundings available with you. But if there is a heavy deposit of a big corporate, that is relatively unstable. They deposit high money, they also withdraw high money. But those who deposit less money, they normally don't withdraw at regular intervals. So these are called, this will be treated as more safe, and it is more safe in terms of available stable funding. So the NSFR is something that is the funds that are available with us for stable funding and the funds that is required to do a stable funding. Okay, the funds that are available with us in terms of small deposits for a shorter period of time are treated as funds available for stable funding, and the required for stable funding is something which we fund for a longer period of time, that is maximum, that is more than 5 years. Okay, so this is the basic difference between, so this is the basic requirement of NSFR. NSFR says that you should have adequate fund, safe fund for doing safe fundings. So you are encouraged to do more safe fundings. Safe fundings means secured loans and loans for a longer period of time. Short-term loans are unstable in nature. The NSFR philosophy says short-term loans are unstable in nature. Okay, unsecured short-term loans are unstable in nature, whereas these short-term deposits are more safe in terms of long-term deposits. Those who put money for long term, they may withdraw it because there could be a mismatch in terms of the requirements. Somebody has thought that he will require the money for after 10 years, but the amount is huge, but suddenly they need the money and they withdraw it. So that will not be calculated as a safe haven for safe resource for safe fundings. So this is all in net stable funding ratio. We have also cleared LCR, net stable funding ratio. These are important, and risk weighted assets and capital adequacy ratio. These all are important in terms of Basel 3, because Basel 3 is becoming a very normal question, and it's a very generic question. Everybody can ask. Anyone who know about banking, he will ask you about Basel 3. But you have to understand the instruments that are used under Basel 3. Like we have discussed about common equity tier 1. There's this preferential shares. We talk about high quality liquid assets. We talk about liquidity coverage ratio. Liquidity coverage ratio, let me remind you, it is the liquidity required for next 30 days. This is called liquidity coverage ratio. And this last one, net stable funding ratio, are important factors, important additions to Basel 3 norms. So this is all in this session. I think we have gone too long today. So in case you will be provided with this PDF, and in case you have any doubt or you are required to go through it, and all these definitions and all you have to be remember all of them by heart, because there could be minute questions out of it. They could ask you the formulas. And also, as a banker, you must understand what is Basel 3 and why these requirements are. This is, if you are asked a question that why Basel 3, then the one word, one sentence answer should be Basel 3 is to absorb shocks from unforeseen conditions. That means the 2008 conditions don't occur once again. Banks should not fail. Okay, if one bank fail, others do. So that is why Basel 3 is required. So that's all. Thank you. Good night all. We will be discussing all our queries in the group. Okay, thank you.